A very famous and smart person once said, gold is both a commodity and a high stock to flow ratio and a monetary metal. As such, the decisive short and medium term factors that ultimately affect price developments are closely related to the current situation of the monetary system and the financial markets. Do you remember who said that?
My colleague Mark.
Well, actually, you were quoted as saying it, so I'm going to give it to you.
I know.
that leads into my question, which is actually overall the sentiment for gold has remained positive, but not overly strong is probably one way of looking at it. Despite the price movement only moving laterally over the previous 10 years, we did have that dip in the middle, but we're back to where we were about 10 years ago. Compared to equities, which are 300% in the same time frame and climbing and seemingly don't have any ceiling. What, in your opinion, are the key elements that are keeping gold in its bull market run? Because it is actually in a bull market now, despite not being super effervescent. And how should we be looking at it in the medium long term, particularly with the negative interest rate programs that are ongoing?
Well, that's a great question. And in general, I would say that the conditions for gold could not be better. We're seeing massively over-indebted economies that will resort to devaluing their currencies as a last resort to basically reduce their debts. If you know and understand monetary history, it's always been like that. I think, as I've said, that real interest rates will remain in negative territory for the next decade at least. And in such a market environment, I think that tangible assets, especially commodities, selected equities in the right sector, and obviously precious metals, should be the foundation for every portfolio. Michael, we calculated some scenarios for the US, for example, which is still the world's leading economy, although it's being challenged by the Chinese big time. And we calculated also based on the CBO, the Congressional Budget Office numbers, some scenarios for budget deficits, and especially the possibilities for interest rates to rise, and basically it's telling us, even with the very conservative assumptions by the CBO, it basically tells us that there's no way that interest rates will rise significantly. Now we're seeing, as everybody knows, we're at the highest debt levels in peace times. And if we go back in history books, and we'll see that we had similar debt levels already after the Second World War, obviously. And back then, we saw a combination, first of all, of higher inflation rates, but also financial repression in the form of yield curve control. So in 1942, the Federal Reserve basically had compiled with the request to this effect from the Treasury Department that the yield on short-term government bonds was kept at 0.375%, I think, while the yield on long-term bonds was kept at 2.5%. So at the peak, real interest rates fell to almost minus 20%. But it worked, and of course it was a massive reallocation of capital, and as a result of deeply negative real rates, the nominal GDP ratio in the US, for example, in 1945 it was at 110% of GDP, and it came back significantly over the next couple of years, and in 1951 it was already at 62%. So of course we shouldn't compare let's say the starting point, because nowadays we're seeing demographics are different. We're seeing this enormous financialization basically of everything that didn't exist back then. So there are many big differences between now and the time after the Second World War. However, I think that the yield curve control at some point will be implemented, be it an implicit or explicit yield curve control, and this in combination with higher inflation rates should work. It should work for the governments. It should work for owners of gold and other assets that work in this environment, but it won't work too well for holders of government debt, for example. It won't work too well for savers. So it is a massive reallocation of capital. But this is happening, and I think the last year was a clear confirmation that we're clearly going into this direction.
Yeah, the phrase "history doesn't repeat, but it does rhyme" is very much the feeling of I get at the moment. And as you say, with the development of different financial products that didn't exist 60 odd years ago, 70, 80 years ago now, it's going to be a very interesting couple of years.